Welcome to the weekly market recap. Today is Saturday, August 1, 2026. What a wild roller coaster ride of a week on Wall Street after a brutal midweek sell-off where the Dow plunged over 1,000 points following the Federal Reserve meeting. The bulls charged right back, powered by explosive big tech earnings late in the week. Stocks snapped their losing streak to finish modestly in the green. The S&P 50 climbed about 1.05%, while the tech-heavy Nasdaq jumped 1.59%. The main hero of the week? Stellar cloud earnings from tech behemoths that managed to completely offset surging treasury yields and geopolitical jitters. Looking across the sector charts, it was a tale of two markets. Consumer cyclicals absolutely stole the show, ripping up over 7.3% thanks to an absolute monster earnings rally in Amazon. Communication services also caught a strong bid, rising 1.51%. On the flip side, defensive sectors took a heavy beating. Utilities got crushed, falling 4.22%, while industrials sank over 2%. Traders clearly dumped rate-sensitive defensives to chase high-growth tech momentum. Where does overall market sentiment stand right now? The Fear and Greed Index is sitting right at 42. That places us squarely in fear territory. Even with Friday's sharp relief rally, investors are keeping one eye closely on spiking bond yields and Middle East tensions. Caution is definitely still in the air. The biggest macro headline of the week came straight from the Federal Reserve's FOMC meeting chair Kevin Warsh, and the Fed decided to keep benchmark interest rates unchanged at 3.50 to 3.75%. While a hold was widely expected, Wall Street threw a temper tantrum on Wednesday during the press conference. The lack of clear forward guidance on future rate cuts, combined with persistent inflation worries, sent long-term Treasury yields soaring. The 10-year yield touched 4.75%, its highest level since early 2025, sending shockwaves through equity markets before tech earnings saved the day. After weeks of Wall Street worrying whether tech giants were overspending on AI with nothing to show for it, Microsoft and Amazon proved the skeptics wrong. Amazon reported its fastest AWS cloud revenue growth in 18 quarters, sending its stock soaring double digits. Meanwhile, Microsoft's Azure cloud revenue easily beat estimates with accelerating guidance. This double whammy of earnings beats proved that AI capital expenditure is actively translating into real cash flow, igniting a massive tech snapback rally. Adding fuel to the market volatility fire, escalating U.S.-Iran tensions caused wild swings in the energy market. Crude oil prices whipsawed throughout the week, holding elevated near $85 to $100 per barrel. Higher oil prices are raising red flags for persistent inflation, which narrows the Fed's room to cut rates later this year. Bond markets are signaling that higher for longer interest rates might be sticking around a bit longer than traders originally hoped. Amazon was the undisputed king of Wall Street this week, skyrocketing over 15%. The e-commerce and cloud giant blew away Q2 expectations, highlighted by an extraordinary re-acceleration in AWS cloud growth and expanding retail margins. Investors who were nervous about AI capex drag immediately rushed back in, making Amazon the single biggest contributor to the S&P 500's weekly comeback. Microsoft delivered another masterpiece of an earnings report, rallying over 21% on the week. Azure revenue blew past Wall Street consensus, and management gave stellar forward guidance for even faster cloud growth next quarter. Mr. Market loves proof of execution, and Microsoft proved that its massive AI infrastructure investments are already yielding real enterprise demand. On the flip side, not everyone joined the earnings party. Apple dropped over 7.3% following its earnings release, as profit-taking hit the stock after a massive 15% run-up earlier in July. It goes to show that in this market, if your stock enters earnings priced for perfection, even a minor slip can result in a quick beating. Moving over to small and mid-cap land, MarketAxess Holdings took the crown as the biggest gainer, erupting over 39% higher. The electronic bond trading platform operator benefited massively from the wild yield swings in the Treasury market, driving record trading volumes and sending short sellers scrambling for the exits. Software provider Blackbaud surged over 31% this week after delivering a blowout quarterly earnings report. The company significantly raised its full-year revenue and margin guidance, proving that niche software providers with strong pricing power can still deliver huge wins even in a volatile macro environment. On the losing end for small and mid caps, Coinbase slipped over 10.5% after reporting its third consecutive quarterly loss. Sluggish crypto trading volumes, coupled with fading optimism around U.S. crypto legislation and broader Fed rate uncertainty, put heavy pressure on the stock throughout the week. Let me pull up the weekly chart for SPY. The ETF successfully defended crucial weekly support at the $538 to $540 zone during Wednesday's pullback pullback, forming a solid bullish tail. On the upside, SPY faces immediate weekly resistance around $552 to $555. If bulls can clear $555 next week, we could easily challenge $560. However, losing $538 support would open the door for a retest of $530. Turning to QQQ, the tech index put in a sharp hammer reversal off the $465 weekly support level. Buyers stepped up aggressively right where they needed to. Immediate resistance now lies at $482 to $488. A clean breakout above $488 puts all-time highs back on the radar, while a drop back below $465 would signal that the tech correction isn't finished yet. Small caps in IWM continue to lag their mega cap brothers, rising just 4.54% this week. Technically, IWM is holding support at $210 to $212, but remains capped under heavy resistance at $220 to $224. Until long-term Treasury yields cool down, small caps will likely remain range-bound between $210 and $224. Crypto markets had a cautious week. Bitcoin briefly teased $66,000 before pulling back to hover around $63,000 to $64,000 following the Fed decision and 4 consecutive days of spot ETF outflows. Immediate support sits firm at $63,000 down to $62,000. BTC needs to reclaim 64,600 and break 65,010 to regain bullish momentum, with major resistance waiting at $66,700. Ethereum showed surprising underlying strength compared to Bitcoin, consolidating near $1,865 to $1,905. ETH has been bolstered by 3 consecutive weeks of net spot ETF inflows, showing steady institutional accumulation. Critical support sits at $1,850, while bulls need to push past $1,950 to test the psychologically important $2,000 resistance level. The broader altcoin market felt the macro heat this week, with major assets like Solana, XRP, and Dogecoin sliding between 6% and 9% as traders de-risked ahead of the Fed. However, Binance Coin, BNB, managed to buck the trend with a modest gain of up to 4.5%. Overall, crypto sentiment remains in the fear zone alongside traditional markets. Heading into next week, market sentiment is balanced on a knife edge. On one hand, big tech earnings have proven that fundamental growth is strong. On the other hand, 10-year Treasury yields at 4.75% and high oil prices are severe headwinds. Next week brings another stacked lineup of earnings, including Palantir, AMD, Caterpillar, Eli Lilly, Disney, and Uber, alongside ISM Services PMI data. Buckle up, because volatility isn't going away anytime soon. That wraps up this week's market recap. If you found this breakdown helpful, smash that like button, hit subscribe, and ring the notification bell so you never miss an update. Drop a comment below with your favorite stock pick for next week, and as always, trade smart out there.